Well, good afternoon then, folks, as we head into US trade on Wednesday, the 16th of August. Now, we spoke about a number of different things. We spoke about weak Chinese data causing some slight bit of negativity in markets as we headed into the European Open this morning. Sterling inflation, or should I say UK inflation, continues to remain somewhat stubborn. And we had some moves off the back of that this morning. Certainly there was a bit of negativity, certainly in Asian stocks, as we headed into the European Open. Those losses were paired slightly, and we saw a bit of a bounce back in over the course of the European session, but we have in recent trade popped back lower again, which we will touch on once we get around to some charts in a minute. In terms of fresh fundamental news flow, though, there's not a great deal out other than kind of preparations for the minutes later on this evening, as well as some housing figures, which we'll have a look at once we get around to the calendar, and some other developments in relation to the moves yesterday. But if we just have a look across the board, we can see stock index is pretty mixed. You can see US stocks, I mean, you can see they're red across the board, but minus 0.1% on the four of them now. Now, they have turned around slightly in recent trade due to the fact that yields have had a slight bit of a pop higher off the back of some slightly stronger than expected housing starts. We'll break that down when we get to the calendar. In terms of assets across the board, I mean, stocks, certainly European stocks, pretty mixed. See commodities pretty mixed. See gold's flat, silver relatively flat, oil up slightly, but in reality they are all pretty flat. Global bond yields, apart from the US, pretty mixed. You can see the US dollar mixed. The Australian dollar lower somewhat across the board now, which has moved lower in over the course of recent trade in the last kind of hour or two, which was maybe a little bit surprising as it wasn't down further this morning. It was pretty, it was up against most currencies this morning, which is not something you would really expect off the back of some weak Chinese economic data. Sterling, strongest currency across the board today, with that sticky inflation print, meaning that the Bank of England may have to keep the foot on the gas in terms of interest rate hikes. But across to the calendar, we can see that UK data this morning that we alluded to in this morning's video, but we can see these housing figures from the US just about half an hour ago, in the lead up to today's US session. Now you can see building permits slightly below consensus, right? They are permits, they're only permits. Housing starts is these permits being acted on, right? And the fact that they have been acted on, that number is the one that is positive, right? So it's all well and good getting a permit, but if you don't actually go and start the job, it doesn't really mean too much. So the fact that these the starting of the construction of these buildings is higher than anticipated, again, that's another strong bit of economic data from the US. You've had, over the last number of weeks, you had strong GDP, you've had strong durable goods orders, you've had inflation tick higher again, you have the strong retail sales yesterday, you come into housing starts today strong. There's been a raft of positive economic data out of the US, which means that markets have to continue looking at the possibility of the Fed keeping interest rates higher for longer, which we may get a bit of an indication of, or maybe some clues as to what is coming ahead from the minutes later on this evening. Now, they did hike interest rates by 25 basis points at the last meeting, suggesting that they may still have work to do in order to get inflation under control. Now, they do have a pretty robust economy. The US economy is performing fine. It's beating expectations. It's doing well. So in terms of keeping the foot on the gas in terms of interest rate hikes, it's not really crippling the economy just yet. Obviously, there's lag effects to take into consideration later on down the line with these interest rate hikes. But, certainly for now, the economy is performing fine, and you'd have to imagine they reiterate their somewhat hawkish stance that there is more to be done and they may potentially need to hike rates again. But a bit of the downside yesterday came, or certainly a bit of the downside in stocks yesterday, came off the back of markets expecting the Fed to cut interest rates early in 2024. And the fact that economic data remains strong and inflation has ticked up slightly again may mean that they need to keep interest rates higher for longer, which is not something markets had priced in to have to come across at some point early on next year. Now, you come across the yield, and yields then pushed lower, right? Yields pushed higher off those retail sales figures off the back of what I've just mentioned, and then pushed lower due to fears that Fitch may downgrade downgrade a number of larger US lenders. Now, let's see the Fitch downgrade, US credit rating. We had Moody's downgrade a number of small to medium size banks within the US. Moody's or Fitch, I said, potentially going and looking at some of the larger lenders in order to push, which is what caused a bit of downside in the in yields yesterday, which was a bit of upside of the back of kind of some safe haven flow. Stocks sold off again in line with that retail sales, and you saw a pretty substantial move over the course of yesterday, lower in terms of the US indices, which you can see the S&P, the Dow Jones, the Nasdaq and the Russell all having solid downside over yesterday's trading session. And the S&P is through the lows, so is the Nasdaq, so is the Dow Jones and the Russell, all four of them should I say, all through the lows simultaneously off the back of that stronger than anticipated US data at 1:30. Now, off the back of that as well, yields has then popped higher, so that's no longer a safe haven play. That's more of an interest rate play of kind of either hike interest rates or keep them higher for longer, which was the reaction initially to retail sales yesterday. But with that Fitch coming out and said that they are looking at downgrading a number of the larger US lenders, contributed to that. That was not an interest rate move. That was kind of rumors in markets and reports circling through the news. The different news sources. Then you come across here and you see a bit of US dollar strength, where you've had Aussie, Kiwi, Euro and Sterling all have a bit of a move lower. You've had dollar Swiss, dollar CAD, dollar yen all have a bit of a pop higher over the last couple of hours. The dollar index itself as well having a little bit of an attempt to the top side. So expected reaction to that, with yields popping higher at the moment. Certainly when we're talking about interest rates, is stocks lower, US dollar higher, and that is the reaction that we have had as we head into the minutes later on this evening. But that's what's to keep an eye on in terms of markets. Stock indexes are through the lows. Head and shoulders that we were speaking about a little bit about this morning do not seem to want to play out on US yields, and if they continue to push higher, you'd have to imagine the S&P 500 and those US stocks do follow to the downside, and then the US dollar is likely to prove a bit supportive for that. But minutes later on, 7 o'clock today, really the economic data on the docket this afternoon, or this evening should I say, with it being London time here. As I said, 25 basis points worth of hikes at their last meeting. What is the rhetoric inside the minutes? Do they make a suggestion that they are not going to look at, or do they reaffirm their stance that they're not going to look at hiking interest rates again early next year, and they're going to have to keep rates higher for longer? That is the decision that needs to be, or that's the information that needs to be found out from those minutes this evening, and that is what we will keep our eyes on as we head into today's US trade.